Imagine if you have invested $10,000 at the start of 2025. Where would you be today? The S&P 500, nice and steady gains. Bitcoin, big swings, depends exactly when you bought it. Gold and silver, gold up around 66% in 2025. Silver was up about 159%. That's right. Two boring metals suddenly became one of the top performer of the year. In today's video, we'll cover more on what drove this massive rally in both gold and silver, and more importantly, how we should position ourselves. Before I dive into the video, hi, I'm CY, and on this channel, I share more on finance and productivity. If you enjoy this type of content, please subscribe to my channel. And now, let's dive in. So, what on earth caused this? Let's break it down. One of the most obvious drivers was a shift in interest rate expectations. In early 2025, markets started pricing in a clear pivot. The Fed and other major central banks had likely peaked on rates and were moving towards cuts. Why does this matter? Lower expected rate means cash becomes less attractive, currency can weaken, and investors start looking for a store of value. Gold thrive when the market thinks money is going to be easier in the future. And those expectations alone help fuel the early momentum. Another major factor often overlooked is geopolitical risk. Investors don't buy gold because they want volatility. They buy it because they fear systemic instability. In 2025, geopolitical tension didn't just simmer. It became a persistent backdrop. There were ongoing conflicts, trade frictions, rising sanction risk, and increasing competition among major powers. This isn't about betting on war, it's about risk aversion. During times like this, investors and especially governments ask, what asset cannot be frozen, sanctioned, printed, hacked, or defaulted on? It's not stocks, it's not bonds, it's not fiat currency, it's gold. Even without daily headlines, geopolitical stress quietly pushes capital towards assets outside the traditional financial system. The third key driver is strong purchase by central bank. Central bank has been a net buyer of gold for 15 consecutive years. Annual purchase exceeded 1,000 tons from 2022 to 2024, compared with a long-term average of about 400 to 500 tons. In recent months itself, central bank gold purchase continued pick up pace, with countries like Poland and Kazakhstan leading the purchase in 2025. Not only that, world central banks now hold more gold than treasuries in their reserve. Even with record high price in 2025, demand remains elevated, not because gold was cheap, but because the underlying objective didn't change. Diversifying away from the US dollar, reducing sanction risk, strengthening reserves, and holding a neutral, non-political assets. This isn't tactical trading, it's a structural demand. The fourth driver is the growth driven by ETFs and futures. Official sector demand set the foundation, but investor positioning amplified it. Gold ETFs like GLD and its peers saw sizable net inflows of $77 billion as of 19 December 2025, compared to just $3.4 billion in 2024, helping price absorb buying pressure and break above 4,000 US dollars. Silver ETF were even more dramatic. By mid-2025, silver ETF absorbed roughly 95 million ounces, pushing total ETF holdings towards 1.13 billion ounces, nearly an entire year worth of global silver demand. When investment vehicle control stockpiles equals to annual demand, even small inflows or outflows can move price dramatically, which explains the movement in silver and gold. Now, as we briefly touched on silver growth partly led by ETF flow, another key driver is structural deficit for silver. Unlike gold, silver has a dual role, a precious metal and an industrial metal, which means there is an actual industrial demand for it. 2025 is on track to be the fifth consecutive year of a structural deficit for silver, meaning the demand outpaced supply even at record high prices. Supply only rose about 1%, mostly because 70 to 80% of silver comes as a byproduct of mining other metals. Higher prices alone don't create new dedicated productions. On the demand side, over half of silver goes to industry like solar panels, EVs, electronics, and techs. Even modest additional demand or investment inflow can push price for silver sharply higher when the market is structurally tight. Now, what does this mean for silver after a massive rally? One of the best ways to understand the relationship between the two, gold and silver, is the gold-silver ratio. The gold-silver ratio measures how many ounces of silver you need for 1 ounce of gold. Historically, it trades between 40 and 80. By early 2025, it spiked over 100 when gold ran first. Later, silver caught up and the ratio compressed to around 60. What does this tell us? When the ratio is high, silver can appear cheaper in relation to gold, attracting more capital and helping explain silver's rapid catch-up. At this point, the massive rally has brought the overall ratio back to the average. Let's be honest, this has been an exceptional year. Growth in both silver and gold are not speculative and backed by strong fundamentals. But big years often followed by sideways or choppy periods, even in the strong long-term trends. The number one mistake, buying after the headlines, then panicking when price pull back. Gold and silver aren't lottery tickets. They are hedges. If you are keen to explore gold and silver, think in years, not weeks. Dollar cost average your positions. Keep metals as a portion of a diversified portfolio. Expect volatility, especially with silver. And the right mindset is to have slow accumulations, not this is going to make me rich in 3 months mindset. If you found this breakdown useful, hit like, subscribe, and tell me below. Are you team gold, team silver, or sitting this one out? Thanks for watching, and I'll see you in the next video.